All right, gang. So we wanted to start off by explaining the origin of Replace Your Mortgage and how this group came to be. So I guess I'll go first and where I started. So I started almost right out of college in the mortgage industry, and I won't get into the details and a long story of the mortgage industry and the meltdown, but shortly after the meltdown, there was a hedge fund that invested in a company that I was working for to get resurrected and started back up. And that hedge fund manager would regularly visit Nashville and sit down and mentor me for about an hour at a time. And he had parents that were here in Tennessee, so he was out of Connecticut and would fly in from time to time. I would imagine on a private jet.
Probably.
Yeah, we got to get a hedge fund. But anyways, when he would fly into town, he'd stop by the office and would look at some numbers, and he would mentor me. And one day, I tried to take the advantage of saying, hey, let me get in your sphere of influence because you're wealthy. At the time, he was worth a couple $100 million. Today, I think he's a billionaire. And let me get into your pocket, so to speak, your sphere of influence. And if I can get in that, then those folks wanting mortgages are going to come to me, which by default, you kind of own this company and you get your money back faster. So we'll be scratching each other's backs. And that's when he kind of hit me with a strategy and said, look, we don't really use mortgages. And I said, well, let me guess, you pay cash for everything. He said, no, we don't. We actually utilize other people's money or home equity lines of credit. And everything I'd been taught leading up to that, all you guys from the mortgage industry, we were taught that HELOCs
I worked with you.
Yeah, that's right. Yeah, Matt
5
worked
years.
with me. In that,
The pleasure of working.
not only the former company, but also the resurrected company. You worked with me there too.
We had fun back then.
Yes, we did.
We had a lot of fun.
Too much fun. And we can get into the fun stuff here in a little bit.
A lot of fun.
But he shared the secret with me of how the wealthy finance real estate. And it didn't sit well with me, so I tried to really try to prove him wrong. The more I tried to prove him wrong, I proved him right.
Do you remember? Sorry to cut you off.
Yeah.
Do you remember you called me? 2012, maybe.
I would have been before that.
Maybe it was 2011.
Yeah.
It was
Because 2012 is when I actually started doing it.
Okay, so it would have been probably the year before. Because
Mm-hmm.
you're like, check this out, run some numbers, see if you think it makes sense.
Right.
You're like, try to find a hole in this, and so I did, and I came back a little while later, and I said, "Man, this is great. I don't know how you're going to do it, but
Right.
this, if this works, makes a lot of sense from a numbers perspective because." That's me. If I'm going to try to poke a hole with numbers.
Yeah.
If I can't do it, then okay.
Well, and here's the other thing. We were all mortgage guys. So we want to poke a hole in it because we don't
Exactly.
want it to be right. We're out there slinging what this guy had said was selling financial crack to middle America. So we wanted mortgages to be right because we're on the phones slinging mortgages every single day. So we didn't want this to be right. So it was in 2012, I finally, contrary to what my wife wanted to do, I dove in head first.
You said to me, you're like, if you think the math works and if I can find somehow to do it, I'm going to do it and see if it actually does work. I remember those exact words.
Yeah.
I'm just going to do it and see what happens.
I called a dozen banks, and at each bank I was talking to no less than 4 people explaining this and what I wanted to do. And finally got one that, like, okay, I kind of get what you're trying to do. Yes, we can do a HELOC in first lien position. And then the rest is history. So it was 2 years later, November of 2014, when I started to do this as a business. When I started I'm not really doing it as a business. I created the course and started the prep work of saying, hey, I want to offer this to the masses and sell this online. And it was actually a marketing mentor of mine that told me that I should do this. So that was in 2014 when we created the course, and then early 2015 is when we started selling the course online.
Yeah, and part of the reason we want to go through this, one, we want to introduce, formally introduce people that don't know us out there, but also we get this question all the time. How long have you been in business? Yeah. Because when someone comes across an online company, whether it be ours or someone else's, and they haven't really dug into anything, done any search on them, one of their natural questions is, how long have you been in business?
Right.
Well, and quite frankly, I mean, it's also like the too good to be true mentality.
Especially.
So it's like they want to see that, hey, this is an established actual company. This isn't like a website. This isn't just a random book that somebody threw up on Amazon. That it's an executable company that actually is legitimate, that's behind this idea that is, for a lot of people, really hard to grasp and really hard to believe that they're getting done wrong that badly on a mortgage side. Yeah. And, they almost like don't want to confront that at times. And sometimes it just helps to know who we are, who the people are behind the scenes, to know that, hopefully you can trust us, and, we have everyone's best interest in mind. And it started right here with you.
And the three of us are all from the mortgage industry or in banking industry at different levels. And then Derrick here, who actually has a more of a tech background too, isn't speaking directly into the mic like me and Matt are, after he's admonished us several times for speaking directly into the mic.
Sorry, it's a little low.
There you go. You sound better. You sound
I wonder if I'm even on the video.
You hear that voice? It's like silk.
Yeah, it's not Barry Manilow. What's the other? Barry White. Yeah,
Barry White.
Barry Manilow and Barry White are two totally different people.
They both got paid for their voice.
Slightly different.
Yeah.
Slightly different.
Oh, man.
Yeah, so, one, we're not a fly-by-night company, but we're also a company built by bankers and lenders. So we understand the antithesis of what we teach almost as good as anyone out there.
Yeah.
I mean, we're still having to take continue education, because we're all certified and licensed, by the way. So you can look us all up on NMLS Consumer Access. You can look up my resume. It's funny because we've had some people that were marketers along with the company and whatnot, and you look up there NMLS Consumer Access, and it's not quite banking. It's more like sales rep at Sears. But, you look us up, we're professionals.
Yeah.
We've been doing this a long time.
30 plus years between all of us and mortgages and lending and banking.
Well,
so there's a lot of knowledge here.
And just briefly, I mean, like for me, I came on here as a client in 2016. I started doing this in a client, kind of fashion first. But, I was working at the time for a company called a very large lender in America.
Bleep. Get sued.
Yeah, that's true. But all that to say, I was working with them, and I loved the strategy, but obviously to really promote this strategy, it was taking dollars out of my pocket. And so it wasn't something that I was really excited about doing. But ultimately, the time came where I was kind of, really wanting to get out of the rat race of mortgage, and ultimately had been a client here, reached out, knew Michael, and just, knew some other people that were on the team, and it was a smooth transition in, and I left completely. Bleep. But that's not, that's the reality is.
It's kind of hard to do both.
Yeah, it is, because you're, look, the reality is too, and we've talked about this on another podcast, but this isn't for everybody, right? So there is still the people that need the mortgage, right? If you have 3% down, 3.5% down, you're looking at a 97 Fannie, or you're looking at an FHA. If you have a 590 credit score, FHA all day, you're not even going to touch this. But for the people that it makes sense for, it's there. So there is a little bit of cross-pollinating, but for the most part, where you make money, and you guys can probably attest to this, where you make money as a loan officer is not those $100,000, $200,000 loans. It's those jumbos. It's those guys coming in $700,000, $800,000, which a lot of these guys, were multi-million-dollar homes. Guys and girls, they have tons of cash flow,
right?
And they're misutilizing it very in a big way.
Yeah, it's almost like you've got to find, and I think that we've done a good job. So we found that niche that's in the middle, right? We're not lower middle class, obviously not lower class that we're trying to attract, because they need to work on budgeting and credit scores and things like that first. But also not the super wealthy, because they're already doing this. Back in the day, me and Chris were walking into a very elite financial planning firm where their minimum net worth you had to be $5 million minimum net worth to be a client. The average net worth was $9 million. I think they had a billionaire or two as clients. So they were an elite financial planning firm. So we got in front of the owners, because Chris knew the owners through his father-in-law, and because his father-in-law owned the company. And so we had their audience, and we did probably an hour and a half presentation of, look guys, this is how this is going to best meet the needs of your clients with what we teach. And they didn't laugh because they were respectful, but we also didn't teach them anything new. And basically what they told us is, look, all of our clients are already doing this. We already advise our clients to utilize home equity lines of credit. So that's not our audience either. You know, they're not paying cash. They're still using other people's money, but success leaves clues. And the wealthy are already doing this. So our market is kind of that upper middle class to lower upper class is really who we're trying to attract. People that have already mastered the budget, they're cash flow positive. And when I say that, that sounds like an income standpoint, that it's not all about income.
It's not all about income.
Well, because you could have a household that's making $5,000 a month, but let's say they're spending $2,000.
That works.
They're killing it.
As long as it's not, a $600,000 HELOC.
True,
it
yeah.
works, but
Right.
they're not going to. They're going to have $250,000 house max.
Right.
And they probably owe $150, $175.
So again, the three people that we're looking for is a little bit of equity. When I say a little bit, at least 10% equity in your home. 660 plus credit score. So we're not talking 580s, but we also don't have to have a 740 credit score to do this either. So 660 plus, and anywhere from in cash flow positivity standpoint, because people say, well, what is that number? Like, do I need to be $500 cash flow positive? Do I need to be $1,000 cash flow positive? And it's all in relation to the amount of debt you have.
Yeah.
Because we've also had clients that make 6 figures a month, but guess how much they spend? 6 figures a month.
Right.
And it's like, you got to be kidding me. So don't think just because somebody's a high earner that they've got it all figured out from a budget standpoint.
Just because they earn it doesn't mean they keep it.
Right.
Right. And I mean, a perfect example of this, I actually just had a call with an amazing woman this morning. She, had a fixed income. She's pension, retired law enforcement. She had her pension. She had her Social Security coming in, but it was a fixed income. She had a bunch of credit card debt. And the credit card debt was single-handedly crippling her.
Yeah.
It was killing her cash flow. And not only did she have credit card debt, but her credit cards were in the 20% range. So she's throwing everything she earns at this, and she's barely making a dent, right? And so by doing the first lien HELOC, and we coupled it with her 457 plan, right? She had a 457 plan that she gets access to no penalty other than just paying her taxes on it. We were able to work out a scenario where this woman can be completely debt-free in 7 years. And it's paying off $30,000 in credit card debt. She also had a signature loan.
So her
She had
credit
an
scores
auto
are
loan.
going to bounce.
Her credit scores are going to bounce. She somehow has a 720 right now, but she's still, her utilization is good. So she's okay there, but it's going to bounce. I mean, you're going to see, 780, 800 really quick. But not only that, she's going to be, I think she said about 57, 58 years old is where she'll be at, and have a $220,000 line of credit on her house, paid free and clear. That's full liquidity, full access, and be on she had over $4,500 a month in fixed income coming in with no debt. And then the ability, if she wants to, get educated on releveraging that debt, creating more passive income for herself, and retiring at a higher level than what she currently is set to.
Yeah.
But I'll just tell you, I mean, she was so sad at first because I was telling her about all her issues. But then when I told her about what the plan was with the 457 plan and then the line of credit, she was, I mean, to put it as simply as possible, she was over the moon. I mean, she signed up right away. She said, "This is a godsend. This is what I've been praying for. This is what this is what I needed. Where were you, 10 years ago in my life?"
Right.
This is a common situation that we come across. Someone with, 15 to 30 or 40,000 in debt, have a lot of equity in the home, not necessarily on a fixed income, but fixed in the sense that they're not getting 20% raises each year, so their income's pretty static. And this is a very common situation. And what most other financial experts will do is have people take out more debt to pay off the current debt that we have. And often people think that's what we're doing, but that's not what we're doing. We are reconfiguring cash flow to make their cash flow more efficient so they can accelerate paying off the debt that they have, and on top of that, their home in a more efficient and much quicker manner.
Yeah.
One thing I do want to address with that story, though, is to make sure that it's kind of a virtual high five to Dave Ramsey, is to make sure that she hasn't changed her behaviors, though. Because if we pay it all off and get it all fixed and get her on the path of being, completely free and clear in 5 to 7 years, that she doesn't re-leverage for all the wrong reasons
Yep.
again. So you have to first tackle the budgeting issue and the behavioral issue.
Absolutely. And in this case, it was an issue of medical circumstances that drove that debt up a few years back. So it wasn't necessarily something that was, in a whole lot of control. Like, it was more of that. So extenuating circumstances, that's one thing. But I agree, budgeting has to be first and foremost.
Well, that comes to a broader category of what we do here. That's why we don't just take people on. That's why we have these consultations. And we don't all just want to know the numbers of someone. We also, especially for me, I want to know the habits that someone has. And I have actually turned people down that maybe could have benefited from what we do just because there were some red flags to their spending habits. And oftentimes, it's not maybe the person I'm talking to on the phone. It's the other person that they're with that isn't on the phone that most of it's coming from the debt. And I'm like, I don't feel comfortable giving you guys access to something that you may end up shooting yourself in the foot with later. So if you can prove to me that you can start working on this debt, you can stick to the plan I give you, and 6 months from now, it's looking better, then yes, let's talk about it then.
Yeah.
Right.
So what I'm trying to get out to people that don't know is we try to be careful because your habits, that's the one thing we can't control. We can teach you everything. We can guide you. We can tell you what banks to go to. We can do all that, and we're good at that, but we can't control your habits. That's on you.
Right.
Yep.
And hopefully that's what the training does. If they take it seriously and watch it all and really, what's the word? Absorb it and put it into practice, then it should fix those issues because now they have a better understanding of how money works. And if they were to re-leverage, they understand that compounding nature, or the simple interest nature, whether it be the HELOC or the mortgage, they understand how to control that better as long as their behaviors change. But you were talking about something, so let's go back to the original topic of this podcast, which was the origins of who we are and where we came from. And I keep pounding the desk, and I shouldn't do that. So Matt, you and I work together. Won't name the company like Derrick has done multiple times.
We just beep it out.
Because those folks are definitely Sue happy. Yeah. Not yours. We're talking about Matt and I's. But we worked for...
We have nothing but love for them, but for the most part.
They served their purpose.
Yeah.
But they were a publicly traded company, very large at the time. I think they eventually got to the point of the 9th largest lender in the country.
They're big.
And stock went from, I remember, like 3 or 4 cents to $13. And I think it was $13. Maybe it was the tail end of 2006 or the beginning of 2007. Obviously, it was right before the meltdown. So I know it was before July or August of 2007 because that's when they literally just pulled the brakes on the mortgage market. And you and I were selling. We weren't really selling. I mean, it was called subprime products, but they were, for the most part, you had to DTI, you had to income qualify. Yes, we had alternative products out there, but I remember the CEO kind of being not mad, but just like, you're missing out on an opportunity, guys, because less than 1% of what you guys are selling is stated income, no income loans. Thank God we did. It's a good thing we didn't. But we had those products, but we didn't because it was higher rates and lower LTVs.
I don't know about you, but I sold a decent amount of income loans. Yeah.
Those stated incomes?
No, so there was stated. I didn't do many of those, but there was no income.
Oh, for self-employed?
For self-employed. Mm-hmm. Now, you had to have some documentation, and underwriters had to say it makes the income they're saying makes sense. Like they would turn it down if it didn't make sense. But for example, I had a lawyer in Massachusetts, and she was like, I make $140,000 a year, and she'd been a lawyer for 10 years, and she showed her lawyers, license and everything, and they're like, okay, we're good with that.
We also had the bank statement too, which that was really good for self-employed borrowers too.
There was almost always a bank statement.
Yeah.
Not anymore.
No. Well, there's
some that are opening it up.
Yeah, they're expensive, but there are some products out there for that. So Matt, you were with that company. You were also with the company. We were shut down for probably 8 or 9 months and then resurrected to just do government loans, FHA, VA, USDA, Fannie, Freddie. And then that was still around. They're still kicking and doing well. And then after that, you went where?
after that,
Just don't name a company that'll sue us.
yeah, I went to kind of a contracting company. I'm not going to name the name.
Mm-hmm.
And I did actually helped with modifications. Ran a department, me and another guy that did modifications.
Oh, so you sold the problem and then offered a solution to the problem.
So
I see what you did there.
that.
You're a marketer at heart.
Did that, so that wound down. Then I went to a large bank. I won't name that name. And I was there for a while. Did commercial asset management, but prior to that, I did basically negotiations between that bank and mortgage insurance companies to try to get the mortgage insurance companies to pay out to the bank because the mortgage insurance companies were bleeding money because of 2008. So a couple of them were actually in receivership. That's how bad it was. So they would find anything they possibly could to say, yeah, you did the income wrong in this loan, or that property value is wrong, so we're not paying you.
Right.
So we had to go back and forth with that. That was actually kind of fun.
Yeah,
but that wound itself down, so I moved over to commercial asset management for a few years, and then eventually got back on board with you.
Yeah. So, I mean, you've kind of seen
I've been with you
multiple levels
15.
of all the aspects of lending and banking, as I have now, from the hedge fund side to the being on the board side to building product side. So, I mean, you know, for the folks that are listening or watching, you know, this company is not made up of, you know, I mentioned it fly by night, but this isn't a trinket that we try to sell online just to make a buck. Like, we actually care about your success, and we put a lot of thought, effort, and love into what we're teaching and each person that we talk to. Because how many people do we say, sorry, this isn't a good fit for you? And there's a lot of companies out there, copycats, that they don't really care. Yeah. Can you get your credit card out? I mean, that's the first thing they're doing on the call. I mean, how often on a first call are we asking somebody to get their credit card out?
I know Derrick, for almost a fact, does multiple calls with his clients before he takes them on board. And the reason he's doing that is he's just making sure, hey, one, he wants them to absorb it on the front end because it is a lot on that first call. But two, he's making sure that he's covered every angle so that when he brings them on board, that they're a good fit, but they're also ready to go.
Right.
Well, and frankly, like our company here that we have, it's a culture. It's not just a company for profit. It is an actual culture that we want to create. And like you said, and you've alluded to many times, we want to bring value to people's lives, not just now, but long term.
Right.
And so for us, you know, as long as I believe,
but that's also self-serving. I'm just being transparent, because if they're successful long term, it still benefits us.
Absolutely.
Dollars are chasing us as opposed to us chasing dollars if we do it the right way.
If we chase value, right? If we chase like the idea of providing value, whether the dollars come or not, they will end up coming as long as you're staying true to that mission. But I think that it's something too, when I'm on the phones with people, I'm not just looking, I tell people this, I'm not just vetting your finances. And you're not just the only one vetting me on whether or not this is a good relationship and good partnership. This is a relationship, and I'm vetting you as well.
Right.
Because ultimately, if you're not coachable, if you are not willing to open up and receive new ideas and take a hard look at them, or allow other people to speak or sow into your life, it's honestly probably not a good fit.
No.
Because we want to enjoy what we do here.
Yeah.
We don't want to be like, oh my gosh, I have to get on the phone with this person. You know, this is like.
You got to have the right attitude and aptitude.
Yeah.
You know, attitude is one thing. You got to be coachable, but you also have to have the right aptitude. You know, you need to be open-minded and understand that this isn't new. What we talk about, what we teach, I didn't come up with this strategy. This was taught by me from a hedge fund manager. He didn't come up with the strategy. This is something that's been passed down for probably 200 years. Again, it's a form of Austrian economics. So what we teach is actually older than the modern day mortgage.
Yeah.
Even though it's old French for death pledge and it goes back, but a mortgage, the way it was structured, was completely different than the way it's structured now, where it is designed to segregate the consumer's income or to separate them from their cash and to prolong how long they pay on debt. Therefore, they pay more interest. And so we're just going back to basics. So, that's something else I want people to understand, that I'm not a brainiac. I didn't come up with this. I just vetted the crap out of it and, joined along with Matt and said, help me vet this because I'm going to do it personally. And then after I did it personally, I was like, dang, I'm never going to do a mortgage again personally. So, well, I say that. There are instances where you should do a mortgage, even if you're cash flow positive and investment properties and things of that nature. But so Derrick, kind of give us your background too.
Yeah, so my background is kind of it's a little convoluted. I went to school for aerospace. Totally not at all this.
Boy.
I know. I was going to school to be an air traffic controller, got certified. I know. But no, praise God. I mean, I there was other doors that opened. I got out of school and got in with a diabetic supply company, worked my way up on the accounting side of things, got into corporate finance with healthcare, big healthcare here in Nashville. And then out of that, a buddy of mine approached me one day and wanted to start a marketing company. He was the operations tech guy. I was there to run the company and all that kind of stuff. So I did that for about 6 years before I sold out of that. And then, but while I was winding that down, I was looking for something else I could do. And was always into numbers and math, and I didn't want to jump straight into, back into a cubicle or a corner office. So I looked at loan origination and, got kind of involved with that, and then became licensed, worked for a large company. I won't say their name.
Yep. They were.
I'll have to wait for them to bleep out.
One of the biggest now.
They're one of the top threes now. So worked there, learned a lot. It was a pretty cool time just because, there's so much learning. But did that for some years, and then started doing this in my own personal life. And then at that point, it kind of came to the head where it was just like, hey, I would really like to promote this to my clients, but to be frank, if I have a client in Brentwood, which is just south of Nashville here, that's coming to me for a $1.2 million loan, I'm walking away from a lot of money if I steer them away from that mortgage.
Yep.
I mean, I'm talking a lot of money.
Right.
If you're getting paid 1%,
1 to 2,
about that, 1 to 2, depending on your setup. But so yeah, obviously then the rest is history. I'm here and loving it, and helping in any way I can. So now I'm work on the qualification side. Some of you may have already worked with me, and if you haven't spoke with us yet, you might hop on the phone with me at some point. But yeah, just helping folks out and doing my best to bring on who should be here and say no to who shouldn't be here.
And again, I just hope this illustrates the resumes of the folks that work at Replace Your Mortgage. Is we're all again licensed and certified, and the federal government requires all of us to have our own unique identifier, right? So mine is 168207. So you look it up, people will be astonished, like, who's John? Well, that's John Michael Lush. My full name is John Michael Lush. Won't tell you my social, though. But anyways, John Michael Lush. And then you can look at all of our resumes and see what we've done in our career to earn your respect.
Yeah.
And to earn the titles that we have, and to also earn the privilege of educating this on a very high level. Well,
and if you're watching this right now and you haven't made the call yet, and you're kind of back and forth whether or not you should, or if you should even give us your time, I think it's important. Do your research. The too good to be true mentality goes out the window when you realize the resumes behind the scenes here. We are accountable for leading people in their finance, especially real estate finance. We're licensed. We are held accountable to that licensing. And look, I tell people all the time, like, for me to give bad advice, it could put my career in jeopardy. And if I do that, especially if I do it too many times, I don't have that career to fall back on.
Not only could we not do this, we couldn't fall back on even going back into mortgages.
No, because we could be reported to NMLS, and there's a board there. We're governed. We're a governed people.
Right. Yeah.
In many ways, but even in the financial world. So we take it very seriously. I know I'm on the phones more on the front end than you guys are necessarily, but you guys do a lot more on the phones on the back end once people are clients. But everything we do is not, it's not going to be something that we wouldn't do ourselves. I mean,
Right.
the one thing I think that's interesting is all three of us here, before we started promoting this, did it.
Right.
You know, I mean, like my wife, my 2 kids, like I trusted my circumstances with it.
Right.
So, you know, as a loan originator, and, you know, so we're not asking you guys to do anything or them to do anything that we're not willing to do or already have done.
I've done it 4 times.
Yeah.
Yeah. And here's the other thing. I'll throw out a challenge. If you have got somebody, or if you could do this on your own, anybody's listening or watching, and again, we're not talking about folks that are living paycheck to paycheck or have bad credit or have little money to put down, but that category that I described earlier. If you can find a mathematical way that a mortgage makes sense, let us know. Just comment below and let us know, because we would love to explore that. Because if that's the case, mortgages pay a heck of a lot better than HELOCs do.
Yeah.
and we would love to go that route. But I'm telling you, we've been doing this for years, since 2014. As a business, I've been doing it personally since 2012. And prior to 2012, I vetted the crap out of it so that I wasn't putting my family and wife in a worse situation. And it worked. In 2016, we were able to pay off our house. So, you know, I would never have thought about doing that with a mortgage, because it would have been too scary. I remember a Christmas time where I was like, dang, you know, I forget what year it was, but we had an issue with, it wasn't our LOS. It was something to do with underwriting or something of that nature, and volume was low. And I'm like, oh, are we going to have to grab a credit card for Christmas? And luckily we didn't. We weathered the storm. But guess what we also had that allowed us to move forward with confidence was a HELOC. It's liquid 24/7. If we'd have been doing that on our mortgage and chunking it down, good luck going and getting we had good credit and had consistent career in the mortgage industry, so I could have refinanced. But a lot of folks out there could not have refinanced to gain access to it. And even if I could have, I wouldn't have gotten it for free. I would have been charged thousands of dollars to get it. In fact, I was talking to Chris on the phone today. He got a deal over from another company that they don't do the education, they do the financing of first lien position HELOC. And this is why we've got folks like Matt on the team, who most of what Matt does is investigate and research bank guidelines and products, so that when somebody comes to us as a client.
He's the nerd.
He is, very much so. And when a client comes to us, Matt is the one that says, pinpoints, this makes the most sense for your situation, because it's not a one size fits all.
Absolutely.
And as Chris says, like yoga pants. Yeah.
I just all of a sudden got this picture in my head.
That picture's awesome.
I have to say it.
Okay.
So yoga pants, what Chris is, and I won't take credit for it, this is what Chris says. This is like yoga pants. Everybody can fit into them, but not everybody should. So, you know, Chris was talking about how he got a deal from another company because they were charging $30,000. It was a $1.6 million purchase, and I think it was going to be a $1.3 million deal after the down payment. And the competing company was charging $30,000 in fees.
Oh my goodness!
Again, $30,000 sounds like a lot if it's $500,000. It still sounds like a lot if it's $1.3 million. It's a lot.
That's a lot.
But guess how much Chris's fees were? $750.
Yeah.
That's because that other company was charging points. So they're trying to take a strategy and still make money on it, right? On the lending side. So the only way to do that is to take it from the consumer. That's the only way to do it. And that's essentially what that company was doing. So, all right, well, we're 35 minutes in.
All right.
And it's 2:00.
Yep.
It's good to go. Anything else about the origins of Replace Your Mortgage? Are you happy you did it?
Oh, absolutely. And I was scared. I'll be honest with you. I was nervous because, I was doing it side by side with being a senior vice president of a federal bank. So, one, I was a little bit nervous that they were going to find me online doing something right. And
Talk
then,
about suing me for mentioning a name.
I didn't say who the name was. I just said they were a federal bank.
Lots of those.
There's lots of those.
There is lots of those.
So, one, I was nervous that they would find out, and I'm hanging on to one branch over here that is my income, because again, I got kids and a wife and a house and bills to pay, and then over here, I'm trying to create my side hustle, and then within, as we talk about, God will get you back if you glorify Him, and I just prayed about it. She prayed about it, and within 60 days, the income coming from this far exceeded what I was making as senior vice president with that bank. And it didn't take me long to say, that's it, I'm going all in. And I was still nervous, still very nervous, because you could have fell flat on your face. But kind of what the same practices that I had to build up my mortgage career is the exact same thing I did with this. I was basically going door to door. I'd have neighborhood meetings and have neighbors over at the house and do a horrible PowerPoint presentation and show them what's going on.
That's what he did to me.
Yeah. I would hit up my insurance agent and say, hey, can I get in your office in front of all these insurance agents and pitch this? And she said, yeah. And she worked out a way to do it. I talked to my financial planner. Hey, how can I get in front of all these financial planners? So I did it the old school way. And now it's cool because we got paid traffic and, professional marketers and people that make things pretty, sort of pretty. And we're still working on some of the prettiness.
We're working on that.
Yeah. But now it's a lot easier to attract a client. Where back then it was hustle. You had to actually had a list, a spreadsheet. That was ugly too. I'm not the technical guy. All the new technology stuff.
We know.
All the new technology stuff, and it's not news. You're like, this has been around for 15 years. What's new to
stuff
me?
from 2008?
Yeah, like this whole Microsoft thing is amazing.
Have you guys heard of Apple?
Yeah, it's crazy. I just got this talking phone. All right. So anyways, thanks for listening to our ramblings and our rants. But I hope that this episode gives you better insight as to who we are as people and characters behind the Replace Your Mortgage brand. And more importantly, yes, we have competitors out there. And I don't even mind telling you who our competitors are. And I only mention the ones that are actually valid.
Yeah.
Because there are some out there that, again, they're just putting a trinket out there. And I think one thing, if you go to replaceyourmortgage.com, go to anywhere on our website, just try to find where we're asking you for money. It doesn't exist. We have to talk to you. We have to have a relationship with you. We have to understand your specific scenario to make sure you make sense for us and we make sense for you. And I'll be honest with you, a lot of people don't. But you can't find a price on our website or a place to pay us on our website because it doesn't exist. However, there are companies out there that they're selling trinkets because all they care about is your money. They don't really care about you. They care about your money. So I don't mind telling you who our valid competitors are. So number one, I would say is Truth and Equity. Mm-hmm. They've been around longer than us, different than us. I wouldn't say worse than us. It's just a totally different strategy to a certain, I wouldn't say totally different. It's just different. They're different.
Well, they use different tools.
Yeah, different tools and whatnot. And they were good back in the heyday, prior to 2008 and 2007. They were huge, actually. And then the other one I would say is valid is the Kwok brothers. Mm-hmm. Good people. But they care about their people and whatnot. So, those are two that I would consider competitors of ours. Everyone else, they're just trying to separate you from your income.
It's kind of friendly competition. It's like we're all in the same league. We play the game against each other.
And at times we collaborate.
Yeah, but in the end, we're all going to the bar for beers afterwards. It's kind of like that kind of thing.
And think of it like this. I mean, if this is too good to be true, mm-hmm. why are there multiple companies doing it, doing it?
There were banks back in the day.
Exactly.
Yeah, and there are today. That's another thing that some people don't realize, that there are banks today that specialize in this strategy. They won't teach you the strategy, but they specialize in a product for the strategy.
And we know who they are.
Yes, we do. And some of them.
So give us a call.
Yeah. Yep. So awesome, guys. Thanks for listening to us. If you want to learn more, go to replaceyourmortgage.com. The only button you can click on that website is to book a call with us or to download our free book. So you can download a book and read that book, analyze it, critique it all you want, book a phone call with us, and let's have a conversation. The conversation is totally free. And what we really want to do in that conversation is just see if you're a good fit for us and we're a good fit for you. All right, gang, take care and God bless.